Today's session is dealing with half-bankable clients. And a lot of people, when I first floated that in the office, they go, what does that mean, half-bankable client? But I think with a lot of finance brokers, it resonates. They know, it's like one of those things, I don't know what it is, but I know one when I see one. They're what we might say, they're in this grey zone, underlying good businesses. We're seeing a lot of these, particularly coming out of COVID, and I hate talking about COVID, it's so far in the rearview mirror, thank goodness. But businesses that are carrying some legacy issues, maybe they've got some opportunities in front of them. If it wasn't for some legacy issues in the past, they'd be perfectly bankable and they wouldn't be sitting on our desks. But they're in that grey zone, and some of them I'm personally finding now, a lot of these half bankable clients have got a patchwork of finance solutions, maybe some fintech solutions, all these different lenders that are almost clogging up the capital structure, to be honest with you. But meanwhile, banks are tightening up. You've got the ATO is definitely on the warpath, something we've been talking about for a long time, but it's really happening. So a lot of these, I know a lot of brokers hear the thing from the bank, look, not yet. We're happy to fund this client in 12 months, 6 months, whatever that magical time is. We've written deals where the broker said, look, in 6 months' time, the bank's definitely going to take it off your hands. Definitely. We just need somewhere for it to live for 6 months. I have this wonderful panel. To my left, I have Marty Chiotis. Thank you very much for coming along. Marty's director at EY Parthenon, specialising in turnaround, restructuring, yes, liquidation, but in this environment, we love to talk about restructuring and turnaround. And I have Daniela Mancuso. Thank you very much, Daniela. Long-time friend of Hermes. And we've also got Chris Slack. Thank you, Chris Slack. Chris is Director at Finance Consultancy. Daniela is with SALT.
Advisory group.
Advisory group.
Yeah, we're pre-launch, so kept it very quiet.
Oh, we're pre-launch now?
Pre-launch, yeah.
Oh, wow. Okay. But long-time mentor to the commercial and
Definitely
finance.
still working, pre-brand launch, I should say. So,
Pre-brand launch, okay. You are a mentor to the broker community. I think we can say that. All right, now, rather than me doing long introductions, I thought that I'd let the speakers do that themselves. And so I'm going to start with you, Chris. By way of introducing yourself, what does a half-bankable client look like in your world? And what do you think we really mean by half-bankable? And just introduce yourself, how you engage with half-bankable clients.
Thanks, Nick, for having us, and appreciate the opportunity to speak on this. Nick tends to bring some very thought-provoking topics to a lot of us, and hence the reason there's a lot of people in the room. I must say, with this, I had thought long and hard about where that sort of concept of half bankable, and at first I saw the topic and thought, you can't be half pregnant, can you be half bankable? And then I thought again about it, and then I thought just the way in which the positioning of that concept, it speaks volumes to where we've come to, certainly in Australia. I think every single client is half bankable, but I think of that from a different perspective, in that if you look at the word itself, bankable, it comes with those two parts, bank and able. I actually think the perspective really for the people in this room and for many of the other brokers out there is, it's not about whether our clients are bankable, it's about whether the bank is actually able to meet the needs of our clients. And I think that's the biggest part that I thought to bring to the discussion today. Every bank will, 99.9% of the time, be very happy to take a transaction account. They'll be just as happy to process their foreign exchange, and they'll be just as happy to look at a merchant terminal for the vast amount. And I suppose that it gets all the way back to the ways in which a bank makes money. My business has been fortunate enough to be set up based on the fact that I've had those different hats, whether it be running an aggregation business, running a brokerage, and yes, I've even had 12 months as a wanker with a silent B as well. That was the sort of experience that led me to know how a bank makes money, and I think it's really important for all of us when we advise SMEs actually knowing how a bank makes money. I suppose to the point of the question though, when you're talking about whether a client's bankable, I suppose most people look at okay, is a bank willing to lend them money? And to that comment that you made at the start, so true. There's so many people that a bank will come back to our clients and say, let's just see another 6 months, or let's just see another 12 months. It's funny, for those that are a little bit older in the room, there was another phrase that was quite common out there. It was like, yeah, we'd love to help, but we need dollar for security. So we're used to seeing these things out there. I think that when I look at that concept of bankable, I think the discussion almost needs to be reframed about, okay, are the banks able to meet the needs of growing SMEs, and certainly the way in which SMEs have had to pivot, yes, post-COVID, but again, a lot of experience in the room post-GFC, post these larger events. A lot of people seem to have forgotten the fact that only a few months ago we had the third largest drop in our share market's history, all on the flick of a pen because of the concept of trade terms and tariffs. And I don't think we're out of the woods on that yet either. So when we look at the headwinds and things that are going on for SME clients, the conversation really needs to be about how the banks and the lending institutions can be flexible enough to meet these SMEs, not about whether they are up to a standard that is set by lenders at this particular point in time. People seem to forget that banks ran out of money. People seem to forget that there was times during GFC and through COVID when we actually had to know the strength of how willing the lenders were, when the lenders actually had that. So it's our job when we're introducing clients to make sure we keep that perspective. Our clients are just there's different lenders that are more flexible to be able to help with those sort of problems. And I'm very curious to see the perspective of other people on our panel, because I certainly think out there banks are very cautious at the moment. That the concept of a bad bank seems to be very different than what it used to be. I think reputational risk for a lot of banks is out there. They're not as keen to pull the trigger to get people out of there. I'd like, from many of us, that's not a bad thing, and there's lots of clients that work better with other brokers and advisors when they're at different levels of the credit curve. But for us, look, that's the perspective we certainly have. We think that whether a client's bankable or not, beauty's in the eye of the beholder.
I feel as though, Chris, I guess a rabbit hole we could go down. We won't. But are banks even wanting to be in the lending business anymore? We won't go down that rabbit hole, but you're quite right. You wonder whether or not the whole capital market shifting to banks focusing more on wholesale funding and transaction services. Daniela, you do a lot of mentoring of brokers and advising brokers on how to grow businesses. It's your shtick to some extent, as well as being a broker, obviously. Why do you think, in talking about half-bankable, why are we seeing more half-bankable clients in the current environment? And how does I guess one of the things that Chris is saying is almost that the bankable space is shrinking. So how are you seeing shifts in growth strategy for brokers in the context of that?
Yeah, so certainly where we come from at Salt Advisory Group, we've positioned our business to support our brokers. That's who our client networks are. So it's brokers, their clients, and their adjacent industries that support us. So we never see a bankable client ever. And I think that probably the way that I've positioned myself within the industry as well. I set up the finance broking business for Fox Symes back in the early 2000s, and pre-GFC worked at all the non-banks. So I always talk about the worst 2 years of my life was when I decided to work at Westpac. So after pretty much doing a nice tour of the non-bank sector in the 10 years prior to that. So for me, leveraging off that experience and also growing my broker network during my last 7 years at Wiser and having the fintech exposure, I really saw a gap in the market to supporting brokers in helping them solve real problems. And aggregators don't do that job very well, okay? Let's be real. An aggregator is just there to either provide licensing services and literally give you access to the banks that don't want to due to the compliance and the accreditation side themselves. So with that gap, what we like to do is make that a real material impact, and that is to help them with the clients that they've got on their desk at a particular point in time. So it goes beyond just coaching and mentoring and soft services. So we partner with brokers and meet them where they're at and where their clients are at. So that might mean they might refer a client directly to us, but we use every referral as an opportunity to coach, upskill and train. So again, meeting the broker where they're at. Some brokers don't want us to even speak to their clients, so we'll never have a conversation, and we simply act as a back office to them because we've got several of our own white label funds, as well as access to over 1,500 funders, both globally and domestic. So what we've done is built a business model around how to help non-bankable clients, and I guess it's part of my mission personally, but what we've now done within the industry. And we're seeing a massive shift. Certainly, if you talk about the points that Chris alluded to with the fact that there's been a very concerted effort post-GFC on what banks will and will not take. Then we've had the COVID period, and you alluded to the particular policies at any particular point in time. And I really referenced back to my time at Wiser, where we would never even tell the brokers what our policy was because you didn't want to have any reputational damage on continually changing policy. And what that sort of highlights is to me, and this is very consistent across most lenders, is we as brokers and indeed our clients will never really know at any particular point in time that bank's appetite is. Because with the rise of data-driven insights, a lender at any point in time can shift and pivot their policy and pivot that based on the risk models that are evident within their business at a particular point in time. So what that means is if they're getting a whole spate of recoveries in a certain asset class or in a certain age demographic or in a certain part of their policy, they won't necessarily communicate that to the marketplace that they're going to tighten up controls on that area, but they'll assess it very differently. So that's where the human and the technology really intertwine. So what does that mean for us in terms of solutions? It means that we need to know our lenders really well, and we need to know our market really well and the players within that market. So for us, what we do is we never say no to a client. We'll always find a solution, even if that means that we can't write it ourselves. Is that smart? And is there an opportunity cost to that? Yes, absolutely. Tom will attest to the fact that we haven't had a weekend for a very long time, and probably that stubborn Sicilian mindset that I've got, not accepting no for an answer needs to shift. However, I guess I do get some personal satisfaction out of being able to find those solutions, and that's why we've got a 1,500 odd lender panel. So I don't know if that necessarily answers the question, but we are very busy and we continue to see that there is a gap in the marketplace, both from a skill set perspective, but also giving rise to where we're seeing significant changes right across the capital stack, where bankable is, we never deal with banks. So non-bankable is where it's at.
That's very interesting to hear you say that every deal, I suppose, that you're helping a broker with, you're seeing as an education opportunity.
Correct.
To level them up. That's very interesting. Marty, you come from a different perspective. You're working closely with the banks often, helping their distressed workout areas. So just a little bit of insight on what that's, because for a lot of people in the room, that's behind the curtain. And what does a half-bankable client look in that context? And how do you get involved and how do you get engaged?
Yeah, so generally we're dealing with clients that are facing a challenge. So that challenge might be from a financial or operational perspective, could be regulatory change, tariffs and how that's impacting the business, or generally strategic change. It could also be other factors like the ATO putting pressure on clients. So we, from that perspective, might be engaged by banks and non-bank lenders to review a business that might be facing some sort of challenge. So with that context in mind, some of the factors or key themes that we've seen over the last couple of years, just in terms of half-bankable clients, are generally clients that are undercapitalized, over-leveraged, just too much debt, not enough equity, and they ultimately need to restructure the business, but they're limited with options because of the way their business is. So I think about technology businesses, or even recently an electric vehicle business where they are asset light, don't own assets, but have a viable business. So I think about that as a half-bankable client where they might be experiencing distress, and trying to maneuver that distress with a bank can be difficult. Businesses that generally have trading losses that are eroding equity. Again, going back to that asset point, if there aren't sufficient assets, that is where it is difficult to look for an alternative solution, look for a refinance or even a restructure. Businesses generally that have financial distress but are not insolvent, and obviously they're the clients that we want to be engaged with early so that we can look for alternative solutions. But those businesses are potentially breaching covenants, but ultimately still servicing debt. So potentially having those trading or cash flow issues, but still servicing their debt, but seeking some sort of forbearance from or waivers from the bank or non-bank lender. And then just generally businesses where they have poor governance, poor internal reporting. There is that element of perhaps we think about AI and how that can be implemented in a business, but where a business might be in distress, being able to build and find those avenues to bring in AI or other technology improvements to improve reporting is also difficult. So I think they're broadly what we see in distress elements. Obviously, they're just some high level factors, but where we are engaged generally could be from a lender perspective. So where a business might breach a covenant, we might be engaged to review that business. Or on the flip side, if a business is seeking further funding for working capital or potentially to expand, we might be engaged to review that business by the non-bank lender. Separately, we might be engaged by the company directly, where we might work with the business to provide a range of solutions. What are their options? Reporting to them on what are their options in terms of a plan if they need to implement some sort of turnaround or restructure. Again, engagement early is key in those elements. And then also on the flip side, and I don't like to lead with being a registered liquidator, but where we might work with businesses to restructure or recapitalise where there's a viable business, and it might actually be important to work through some sort of formal appointment scenario where the business comes out the other end through a restructure or, again, liquidation. I don't lead with that. But they're just generally how we're engaged and where half-bankable clients come up in where I work with.
I want to ask you a left field question, if you don't mind.
Yeah.
I have met people over the years, because you're working with the bad bank areas. I have met people over the years who've said that businesses have wanted to get into bad bank because that's where the skill sets are, whether or not it's external, like you or someone within that bad bank area, to actually understand their business and give them extra funding, for example. Does that happen? Or do you ever see that?
Look, it depends on the circumstances, but we often are appointed or engaged when a business has some level of gap or there's a knowledge gap between the lender and the business. So they might not have a CFO or proper reporting mechanisms, and we often see a lot of that element where the bank doesn't have complete visibility on the operations of the business, and sometimes coming in as a third party and providing to the business, because the company is taken through this process as well. It's not just one-sided. We might ultimately be engaged by the lender, but we're still working with the business and listening to what they're talking through, what their distress points are. So providing a report that ultimately pulls an independent view and bringing out aspects where they might not have considered, or perhaps they know that those elements are missing, and trying to piece them together in a way where the lenders might be willing to potentially fund. I've come across a recent business where manufacturing, a lot of legacy issues still from COVID. People still keep talking about it, but there are still legacy issues. And I think about this manufacturing business in particular, still experiencing issues, working capital crunch still to this day, and constantly requesting short-term funding from the lenders. And the lenders are thinking, don't you know your working capital needs? Why are these requests still coming? And I think about that half-bankable perspective, because they have a viable business, they have sufficient property to back their debt, but ultimately it's the knowledge gap of, okay, what is the need? What is the ask? And then the lenders kind of work with that. So it does come down to obviously trying to build that knowledge and that reporting where that communication might lack between the lender group and the client.
It's interesting. I've got Catherine, my general manager, for example. Some of the things that you're saying there might resonate a little bit, because it's not just the knowledge gap between the bank doesn't have, the client doesn't have it either. And very often the process that you're going through helps them fill that in. Chris, so just looking, everybody talks about ATO at the moment, right? That's the obvious one, although brokers still want to talk about it. It's funny, I've been talking about it for years, but they're still very engaged by it because they keep cropping up and blocking deals. But aside from the ATO, what else are you seeing that flags a deal or pushes the deal out of that bankable space? Is it just the ATO? What other issues are common quirks?
Oh, look, Marty said it best before. Covenants are really the area that I see that has really driven whether a deal has been, not whether it's been bankable, although we've seen a few examples whereby working closely with a bank and offering a more aggressive covenant might make them bankable. A lot of the time, I think one of the most underrated things that we can do as brokers is really negotiate heavily with lenders on the covenants. Obviously, there's ongoing requirements for some of the non-banks, but the covenants that banks seem to offer, they don't seem to be so willing to get rid of them. So you might have a client who you've done some amazing lending, and they've been really active at the early stage of that client, and then all of a sudden they've decided to keep the aggressive covenants once the business is more mature, which certainly makes it more difficult for them to establish a business as usual relationship with a bank. So for us, we do see a lot of work right now with our best clients. All of a sudden those covenants are starting to hit a little bit harder, and we're certainly seeing clients on the other side because those covenants, I suppose, a lot of them haven't been understood initially too. Certainly, I also think that there is a bit of a culture whereby a banker for a client will move those sort of things to the side of a broker and try and get those quickly signed off, and just another piece of paper. All money's clauses are back, and they are a huge issue. especially when a lot of people that are trying to help, let's face it, apparently commercial's the new black. There was a lot of mortgage brokers that decided they were going to diversify into this space. And there's a lot of equipment finance brokers that I suppose look at different elements of these things. You'll quickly be found out about your knowledge and how you can assist a client when a bank puts an all monies clause, and all of a sudden that $50,000 ute that someone wrote the other day, all of a sudden, hang on, that's a breach of your covenant, which is incredibly aggressive, far from fair. And a lot of, I suppose from our perspective, we see a lot of amazing businesses that turn over between 5 and 50 mil who certainly don't have the level of expertise that a bank is expecting them to have. And nor should they. Their job is to focus on their business. They're very good at running a waste management business or running a transport business. And when a lot of the lenders, and you talked about it before, Nick, in terms of, and Daniel as well, in terms of the stack, when they get that quick little sugar hit of money that because they needed that and that was something that could be sold quickly, they go to their banker, it takes them a few weeks. Then all of a sudden covenant time comes up and all of a sudden they're having to do something about that. So that's probably been front of mind for us. The ATO being obviously a large part of whether it's covenants or not, it's still regularly looked at. Obviously it's much more obvious when someone hits a DPN or they've hit the button and all of a sudden there's a default. I think the ATO activity, there's certainly a lot of talk that banks are accepting more of that, but we certainly don't see that so much on the coalface. We certainly see that, and I suppose probably the biggest bugbear of nearly every broker and advisor I know is the concept of what constitutes, when we talk about bankable, I suppose you have to come all the way back to the concept of new to bank. And the thing that would get most brokers who have been around 5 minutes quite aggressive and angry is the fact that every single client that is new to a bank will be assessed more harshly than an existing client, period. It's a hard one to swallow because as a broker you expect, hey, you should want the business of my client, you should want to take on more clients, and in reality that's not the case. The serviceability tests are hard. The way in which they look at them is with a finer tooth comb, and then it's up to us to be able to explain that story. Every single client, it gets really annoying, my patter's the same. I tell every single client that I talk to, I've got 2 jobs. The first job is to sell them as best as possible I can to a bank or a lender. And I tell them that's the easiest part of my job because if you want the money, you're going to help me with that. It should be easy. The second part is much harder, and that's explaining how a lender actually treats them. And half the time, certainly coming out of COVID, certainly coming out of GFC, there was elements of that the average SME shouldn't have had to deal with, i.e. the sources of their funds, i.e. the fact that there was restrictions on different industries. Those things aren't going to change, and we've got a room full of advisors that work in different ways to solve client problems. But the barriers that are there, the ATO, yes, that's always been the case, but a little bit more prevalent. And I suppose you were talking before, my father would know barely anything about what I do day to day, but he's asking me all the time about private credit because it's in the news right now. And this is the challenge I think we all have as advisors to SMEs, sorting out the noise and some of the vocal minorities versus actually getting down to solving client problems. But the barriers, covenant reporting, ATO, and I suppose both sides. It's not just about the ones that are struggling, it's actually about the really good businesses that potentially those covenants and those ongoing requirements require that ongoing advice. They require someone to bother to take that step.
Yeah, that's right. That ongoing, I've always said that, I mean, it's a great trick that any broker can play with their client is if you've had the client for 10 years, you've got the corporate knowledge of that client. We've talked about this before. And you've got to ask a client to name their current bank manager, or even just say how many bank managers have you had in the last 10 years. It's chalk and cheese. Danielle, you said something earlier, actually, which I found a little bit scary, to be honest with you. The whole Sicilian thing.
Sicilians, that's why we get along there.
Look, we do, and we pay tribute. The thing is, you mentioned you don't take no.
I don't take
No. But sometimes there are deals that just simply aren't going to get done. They're never going to get done. And I've got a good friend who manages a broking business, and he gets cranky with his junior brokers when they start on some of these non-bankable type deals because they're wasting your time. You're better off just walking down the street and cold calling and be more productive kind of thing. How do you help brokers? Two aspects to this question. Firstly, how do you guide brokers to not waste their time? And how there's a thing that when I started out in finance back in the 1980s. One of the training courses we had at AGC was how to sell a reject. In other words, how to say no, but keep that client warm for the future. There's definitely a need for what you do, because you're right. And I think that you're talking about these lenders coming into the market. Again, I go back to my old AGC days. We used to start in collections. Right? The idea was you start in collections because you need to learn, you need to see the files that go bad and understand. All of that went away years ago. So people, all of a sudden, there was all this free money around, and people go, "Oh, we'll get into lending. How hard is it?"
Yep.
You need to know a few little bits and pieces. I'm not saying it's the same as heart surgery, but there is a certain knowledge base. If you're going to be that client's trusted advisor, then certainly you need longer term solutions. Marty, when in your area, often the bank needs to choose between rehabilitation, which is something that you've talked about without using rehabilitation as a word, but rehabilitate, we want to keep this client, they need to be rehabilitated, we want to keep the client, versus we don't want to keep this client, we want them out one way or another. Now, obviously that's useful for brokers to have a bit of an insight as to whether or not they need to shift that client away, or whether or not they need to work with the bank and maybe with some adjunct solutions. How does the bank go about deciding which bucket to put? Firstly, if I identify that correctly, we want to rehab and retain versus we want out. And how do they make those choices? Like, how can a broker know my client really needs to shift?
Yeah, most banks generally have those they've even called that retain, in terms of retaining those clients that might have some level of distress, and then obviously exiting. A lot of banks do have that level of team structure within that wider group that deals with those clients. It's interesting because a lot of businesses generally, when they fall into that bucket, they've breached a covenant and they're placed on some level of a watch list where they might move into that team that is overseeing businesses that are experiencing distress. It really depends on the scenario. Some of these factors are not in isolation, it's a combination of them, but I think of some that I've come across recently: poor communication with the lenders, lack of strategic direction by the business itself, really evasive communication with the client and the bank. And again, new bankers do come in and take on these files and they try and work with the clients to retain them. But if there is poor lack of reporting, poor internal controls, it is really difficult, we've seen, to work with the client from an independent perspective to report to the bank, and the bank's likely to potentially try and move that client to an exit phase. And we've seen that. I've seen that on quite a good, viable business, but that director came in, was trying to turn around the business and was doing a lot of good work, but just the reporting to the bank really lacked, and they just couldn't get past that fractured relationship. So that trust, it's really hard to build that trust back up again. So that's one definitely where I see they move into that exit phase. A lot of the time where there are constant covenant breaches, missing payments, asking for waivers, I've seen banks want to retain clients from that perspective if they have a viable business. But again, it really ties into the other factors that might impact the bank's decision, like that trust, that confidence that they have in that business. Where there are liquidity issues, again, comes down to that working capital management. So I think about that business that kept seeking short-term funding, and that was like every 6 months, we need funding to fill our working capital gap. And the bank was like, what is your ask? Ask us once and don't keep asking, because ultimately it shows that you don't understand your business in its entirety. And that business moved to an exit phase, and that was a viable business. So it really depends on the factors that you might come across. A lot of the time in distress scenarios, the business itself might think that their assets are worth more than what they are in a liquidation value. Never. Often or not, every single time. And when a valuation comes in where they might need more working capital or more funding, the value is a lot less than what they expected. And of course, that's an issue. And that's where, obviously, with a combination of other factors, that might look towards some sort of exit or retain. But it really depends on the scenario. But it's not just one factor in isolation, I've seen. And it's really about engaging with the client and having some level of transparency with the lender. Find if they're in the dark the whole time, especially where they're in that distress scenario, that really builds that lack of confidence with the business and the lender group, and ultimately that fractured relationship that's really hard to come back from.
Have you ever had one where the bank's got retain written on it and you've gone, this one's got to exit, or vice versa. They've put the exit stamp on it, and you go, hang on a minute, we can retain this one.
Yeah, look, I've come across it often. One that I've come across where I was appointed a receiver. So it actually went to a formal appointment scenario. That should have probably been retained, but because of the lack of communication, actually it was the facility expired 2 years prior to the day we were appointed. So you would think that, okay, that might trigger a discussion with the bank or perhaps looking to refinance. That didn't. And in that scenario, we got appointed receivers of that business, and it was a viable business. They ended up refinancing. Thankfully, the broker had some good connections to work quickly, but they probably should have been retained. And also where there is a viable business and we've reviewed the business, I've come across ones in particular where we've said, okay, actually, there is a business here. These are the issues, and these are what we recommend in terms of working through them with the client. And it doesn't happen as often in terms of moving from exit to retain, but it does happen. And then on the flip side, yes, when you do a deeper dive, when you're engaged as an investigative accountant to review a business, you might see more. So asking more questions than perhaps the lender has access to that information, it does trigger obviously some sort of recommendation that might change from retain to exit. So it does happen
In
more
both
often. The
directions.
retain to exit, it happens more often, I suspect, than the other way. Yeah.
Okay. Chris, we talked a little bit before about I guess Danielle and everyone's mentioned the short-term fixes, and I've talked about the broker's role as trusted advisor on the longer term rather than just being the Band-Aid. How can brokers position themselves as problem solvers rather than chasing the sugar hits?
I think, and touching on Daniel's point as well, I think it's important to know, and again, preaching to the converted to this room, but there's an ecosystem that I think has gotten to where we are today. And touching briefly on what that looks like for a broker first is actually important. There's a lot of newer industry brokers that, hey, they're hand to mouth. They're not doing as well, and potentially they're overreaching on particular clients and particular situations. It takes a while to get to the stage to learn the importance of actually saying no at times. But a really good colleague that you and I have known for some time, and Jacob in the room as well, gave me a really great expression early on, and he taught me about the importance of the fact that dreams are free. And if you know your stuff and you know the fundamentals behind a client situation, you know that there is certain clients that, okay, not only they're not bankable, but they shouldn't have the money, period.
100%.
So you've got to call that out. And it's a hard reality, and we're obviously there to help. But I think that you earn more trust around a client. You earn more trust actually calling out how things are to the group around a client. In terms of our position on how we work, and I suppose that whole concept of a trusted advisor, it's also important to sort of see where our business looks at an SME client. We would see the director of a business as the quarterback of their own business. Now, there's different ways in which they look at different decisions and options, and I think a lot of blending when these clients are struggling at different stages of opportunity relies on their opinion towards the opportunity cost of their decisions. So when things get a little bit harder and they're making a little bit more strategic decisions, they have to rely on the team around them. So for us, we make sure that we are considered as part of that team. We work really closely with their accountants, their advisors, whether it be a business coach, whether it be a payroll person. There's all sorts of people that form the centre of influence for a client, and each industry can really vary in that space. So I suppose our part to that is we make sure that we are part of that, I suppose, team that's around a client. We have a particular role, but we make sure we engage with the other areas of that team, because otherwise you end up over-promising, or you end up coming up with, you can have the best strategy in the world with the client, but if they don't take it up, what's the point? And a lot of us spend a lot of time, and I love getting into the mechanics of a transaction, but if the client's not willing to take that, we've all wasted our time. So it's important to be around those other parts. And I suppose if you overpromise and you're a broker, you also probably need to understand that lenders, like if you're a broker, the lenders that you work with are your suppliers. So if you get a reputation of not working closely, look, clients come and go. There's a lot less suppliers out there, whether it be 10 or 1,500. You need to make sure you have really close relationships if you want to get the hardest things done. when you actually say no to a client, you want to be able to look yourself in the mirror and say, damn, I've done absolutely everything I can to be able to help that client within reason. So that isn't just limited to what you do with a lender. It's certainly how you play nicely and you work with the advisors around a business as well.
I often do say to a client themselves, my job is to protect you from yourself as well. And so you've got to run point and make sure that and when I talk about the services we provide, it's not just lending. So it's not never about just providing a dollar solution to the problem.
I'm going to ask you a question just 1 second. I just want to say time is slipping away, believe it or not, because and I've got another 15 questions to ask, but that's not going to happen. So I'm going to ask you one more question, Marty, one more question. But there is a $150 voucher to dine at this wonderful historic establishment for whoever asks the best question. I know we're in a room full of talkers. I'm sure that you'll have some best questions and that the panel will adjudicate on that question. So rather than me asking all of the remaining questions, I'll just ask a couple more and have a think about that. So I'm going to skip to my last question for you, Daniela. What, you say you're advising brokers in growing their businesses. I still love that thing that you said about taking every deal as an opportunity to ratchet up, is almost what you're saying. What are the opportunities for brokers looking to grow?
To really grow their network. Right. So you talk about your network is your net worth, and you were talking about we're the quarterback for our brokers' businesses. So we help bring all of those support services around that. We talk about, people use the word, it's very overused, the word of ecosystem. I talk about it's a universe. We've got lots of worlds in our universe. We might play in the world of restructuring or insolvency, or we'll talk about what equipment finance, asset finance solutions, but we always about providing the solutions for that broker and their clients. So it's not just limited to lending. And then giving them a pathway of introduction, because all of our business is referral based and all repeat business. So we don't advertise, and the reason why we haven't launched the brand is because we just need to get on top of volume that we're dealing with at the moment. So in terms of business, a lot of brokers talk about lead generation being the biggest challenge that they've got, but not just the lead generation, the cost of acquisition. And if particularly in the asset finance, equipment finance, and even the mortgage broking space, leads have been traditionally in the last 5 years generated through your digital channels, and all that's done is made wonderful multinationals who don't like to pay tax in this country very rich. So it's propped up with the Googles and the Facebooks. Well, it has, right?
Yeah.
And that cost of acquisition, not only is it the most, apart from their team, that's the most expensive part of their business.
Can I ask you, it's a little bit off topic. Every time I go on the interwebs and the socials and stuff, I seem to, this talking head comes on and says, hey, mortgage broker. I'm not a mortgage broker, but I buy leads off me.
And that's the algorithm talking to you, and whoever's paid the most amount of money that day.
But are brokers doing this? Are they buying?
Yes, they are.
They're buying, because you talk about networking, which for me is key.
They're buying leads. They're buying leads and getting nothing. And brokers particularly saying that. So I set up Viking Aggregation most recently, and that was in the asset and equipment finance space. So we went to market, and I spent 2 years putting that business together at the back end, and then that period before we launched, and did a huge market analysis both in the aggregation and in the industry space. We had a lot of conversations with brokers, and I've got 15,000 brokers in my network. Every single one of the assets, and this is say limited just to asset and equipment for the purpose of this example, they would generally buy their leads. They spend traditionally $100 a lead, buy 10 leads, okay, $1,000. Out of that $1,000, you might get to speak to 5, and you might convert 3, okay?
That's not bad.
So that's not bad, right? Now they're not even getting to speak to 1, some of them. So the market is oversaturated, okay? It's being cannibalized. So the market is cannibalized. It's oversaturated. It costs a bomb. You're not paying $100 a lead now. You're paying $200 for the same lead. So what are aggregators doing? They're trying to solve the problem by providing bid services, some of the aggregators. So you can go bid for a lead. Now that bid service, that same aggregator, I won't name names, they went to market with that service 3 years ago, and they were bidding for leads, and it might have cost $300 for a commensurate lead, right? That same lead today is costing about $700, $800. So again, my job is there.
For $800, I want to be able to get through.
You want to, and you want to be able to convert it, right?
Yeah.
And if you're a business, a fledgling business, particularly asset finance space, that's a lot of money, right?
Yeah.
It's a lot of money for me. I'm not going to pay. I'm never going to pay $800 for a fucking lead, pardon my French. But so what I said to my brokers, my job is to encourage you and build your business and your mindset up to a place where you never ever pay for leads.
Again, it's another. We could do a whole session on it. We won't. you're talking about it's not just finance, because yes, you may not be able to, but there's other solutions.
It's
And I've
creating-
said you've got to have a team.
It's about
Yeah.
creating that true circular economy.
Yeah.
The law
Yeah.
of reciprocity. I send you a lead, you're going to give me one back.
Yeah.
We don't have the arrangement. Automatically, we've created an unspoken contract. So
Yeah.
our leads actually come from our referrers.
Yeah, and in this space, I think that if I can just talk about myself, it's something I hate to do. You find that hard to believe. But I've always thought it's not me, it's the team, it's the people. Even this wonderful panel, for example, it's who are you bringing to the table, right? Yes, I know that Chris may not have that solution, but I know that he's really plugged into some other people, and he knows someone, he's going to pick up the phone and solve that problem. Okay, one more question, and then I'm going to throw to the floor. You mentioned before this receivership type scenario, obviously that was brewing for 2 years. These days, a lot of the businesses that are in that bad bank area or being reviewed, they have brokers. What advice do you give brokers? What should brokers be doing for their clients that are in those scenarios? Do they help them engage? Are they helping filling the gaps? What is it? What should a broker do?
Yeah, so I think generally I see the broker as the trusted intermediary and advisor. So it's really about making sure that communication between the lender and the client is there and constantly where there is distress or some sort of challenge, obviously within reason, but being transparent to the extent it's required to be transparent. I see them as being that intermediary to build that trust and keep that trust. I also see them as the advisor to perhaps flag things where engagement early is key. So where there might be an issue or your client has suggested there might be an issue, it's thinking outside of, okay, what are the next steps? You might need some advice here. Engaging with these types of advisors is important now. And I think that's key. If you can engage early and there's a viable business, then working through that early is important, ensuring you have enough runway. And then ultimately, I think thinking about alternative solutions. So we talked about private credit. I think back to 2020, the private credit market in Australia was up at 100 billion. It's now, as of last year, over 200 billion in terms of funds under management. There is so much alternative finance and solutions available. So making sure you have those relationships to think quickly in the sense of, I think about that receivership, being able to refinance a business very quickly, because that's important when you're faced with certain challenges where you don't have a runway as a business to work on building relationships and finding what type of solution works. So I think thinking outside the box and using those relationships that you already have is important.
Do you know the ATO has 20% of the private credit market? So the private credit market's 200 billion and the ATO's owed 50 billion. Anyway,
It's interesting, isn't it?
It is. All right, okay, any questions?
Nick,
Anthony.
thank you. So I was at a poker game last night, and under the exit retain part of the discussion.
You got to know when to fold them.
When the guy, and I've been playing for 20 years with the same mob, so when one of them's bullshitting, straight away. But the hardest part for the whole panel today is taking a person at face value and knowing when they're lying to you. Because the retain is, if you at least believe you're working with someone honest, it's worth putting in the effort. But if you know that there's something off, so what's the best tell any of you have picked up?
Ooh,
That might
that's a
help me
great
as an
question.
insolvency practitioner.
Best
Tom
tell.
might be able to answer that one. I think when you've dealt with clients as potentially as long as the people in this room have, it's almost something that you can pick up intuitively, right? So you can smell a rat. It's the reason for the cliche. You can smell a rat. And I say to them straight up, what you tell me, if you give me information that's incorrect or incomplete, all you're doing is shooting yourself in the foot. We're just delaying the inevitable, because you will be found out. And Tom actually says to clients, what is it? If you tell a lie.
If you lie, we say goodbye.
If you lie, we say goodbye. Okay, so it's our motto. If you lie, we say goodbye. So that's to the broker and to their client. And it's we often say this as a predicator, which isn't necessarily true, but we say what credit see they can't unsee. Okay, so tell me the full picture, because then I'll know exactly what the strategy will be and who will position it to. So that's, I don't know if that
You guys
answers
need to
your
write a book
question,
of
but-
aphorisms. That's fantastic.
Yeah, exactly.
Yeah.
What
What about-
one? Do you want 100% of nothing or a
That's
percentage of something?
So that's what we say to brokers who engage with us.
Okay.
Do you want to get 100% of nothing out of this deal, or are you happy to get a share of something and get the solution ultimately for your client?
I think when you ask a very exhaustive list to a client initially of what you need, you soon find out the people around them, because half the time they can't come up with the information, so you get to meet those other people in the value chain of that client's network. But I suppose the other part is you can tell actually a lot more about what they aren't willing to provide. The big thing that COVID gave every bank and most lenders and a lot of SMEs, they learnt the importance of a bank statement. A bank statement shows so many lies if you really want to look at tells. So that would be one of the quickest ways. But then again, people adapt, and when someone really wants to try something on, there's lots of different ways they do that. So by having the exhaustive list, seeing their attitude to what you've asked for, obviously we'll try and do what we can with the information we're given, but I suppose the other side of that is the advisors around a problem. A lot of the time you'll see a problem or someone will ask for something and you'll pigeonhole the way you're thinking from what you're asking them to receive. No secret, Nick's into debtor finance. I don't know too many clients that put their hand up and go, I love debtor finance. So when someone's actually asking for debtor finance, I know they've probably already had it or had exposure to it. So when I ask for information for any client, I don't limit the way I ask for what I'm asking for based on the solution I think. I make sure I have a slightly wider net for what I'm asking questions about, because that way I'm not pigeonholing my advice until I've actually seen everything, and that way I get to the best outcomes.
I think what you said though at the beginning there, it's when information's withheld is certainly a tell.
That's the
What
biggest
about yourself?
Yeah, look, I think, and you probably are the same, being overly cautious, because we obviously deal with a lot of interesting characters. But yeah, when you start asking questions and the story doesn't add up, that's where that red flag kind of pops up. Okay, something's not right here, and that's where that intuition plays in as well. But you're right, going through that exhaustive list, but it is where the story doesn't add up. Most of the time.
Half the time is their attitude to the list as well. Like if you get any attitude early, straight away, hang on, what are we trying to hide? And then it actually gets back to that having rapport with that person, to have that, okay, what's really going on?
And what we'll do to de-risk that is we'll say, okay, what we'll do to make this easy for you is I'll deal directly with your accountant, just give you authority to speak directly to your accountant, and I'll take that problem right out of your hands and I'll get that solved for you. Number one, if they're happy to share the accountant's details, at least you're going to get all the information all in one go and directly done. So that to us saves time, but it also does tick off a box in terms of the authenticity piece. Talked about bank statements, we immediately send out the bank statements link. Complete your bank statements link. Let's have a look at you. That gives me your statement of position, not what you write down on your assets and liabilities. I don't give a shit about what you write on a form. Let's see what we can get easily accessible, quickly into our network, digitally and optimised for us to be able to provide a full scale of solutions.
All right. Anthony has half banked that lunch voucher. Let's see if we can unbank it for him.
Some of it's a statement, some of it's a question. I don't think we all aspire to be the trusted advisor. Unfortunately, we will become the outcome advisor.
Sure.
And I think if we understand that, then we understand what we're dealing with. The other component, when you talk about a debt stack or an asset stack, because of all this wonderful blockchain, smart contracts, stable coins, it's becoming a broader feeling frenzy for specific businesses to go and get finance from multiple avenues beyond Australia. Okay. Much more cost effective. How are you handling this when you see somebody that's got these alternative assets when you look at a lend?
Do you want to? We do a lot in alternative assets, but I'll go on.
I'll let you go first.
All right, so we do quite a bit in alternative assets, both financing them. We've recently done $15 million worth of pink diamonds. So we were able to negotiate with a private credit provider who took the pink diamonds. It's going to be housed in a fund and used as an investment product for the client. Globally speaking, we get funds both domestically and globally. The cost of funds and the type of funds that we can get globally are much more attractive, to the point where we're actually flying. We'll be in Asia shortly to expand that further and cut out the middlemen. We're really sick of seeing the same middlemen who are using the same institutional, and they're not even institutional, the same white labelled institutional funding, and now we've got white label, nothing really more than brokers, but lenders all using the same funding line with the same legitimate issues. And we're finding brokers that they're not getting a no from lender one, same funder, going to lender 2, going to lender 3. It's the same funder. They're going to 3 lenders.
Well, Sayed was at a function with a whole room of, it was one of those networking,
Oh, the Engine was there. Arc was there. It's all Composite Capital.
but they're all using the same
They're
warehouse.
all the same.
Yeah, yeah.
So come
yeah.
on, guys.
They're all selling the same.
They're selling the same product. This was
Yeah.
nothing more than brokers. So that's where, again, we use our
Yeah,
value
yeah.
proposition in helping out that.
Do you see any of these weird and wonderful assets?
We do often, and it really, again, depends on the client. But I find a lot of the time where there's private credit in there, they're really workable and want to potentially work with a restructure and change the debt stack. We have one at the moment in trucking business and over leveraged significantly. Private credit's in there as a mezz lender, and their willingness for a debt to equity swap is there, and it will probably happen at a later point. But and that's in the broader SME space. Like, I find they're more flexible, and it depends on the private credit fund, but also, again, workable towards those alternative solutions where you might have, that might not work directly with a bank, which often or not, it depends on the asset. But there are,
Sorry.
yeah.
I definitely want to address this. I left myself last for a reason. So what was your name again?
Bruce.
Bruce.
Yeah.
Bruce, from my perspective, I completely agree about the fact that everyone is looking at outcomes. And I think that when people are looking at whether they can get cheaper money or looking at alternative products, look, I bothered to go to the IFA conference in America. I bothered to get out there because I truly want to know that whatever we've able to source for a client is the right outcome. I do think there's a really dangerous situation around there whereby there is this perception that everything's cheaper overseas. I really think there's a lot of people that, I think Buffett made his comment about when the tide comes in, you can see if people are wearing any clothes. I do think there's a big move for a lot of people that seem to think that, okay, there's a magic pill, there's a magic solution offshore. I do find, personally, I did my maths, and a lot of the lenders in the States, I didn't think they weren't that much cheaper and whatnot. I think there's a lot of narrative around that, but I think as professionals, it's not about the name or the brand. It's about knowing that whether we talk about a debt stack, it really should be the security stack of the client and actually getting to the bottom. It's very easy to get caught up with brands and names and everything else. But at the end of the day, the client does not give 2 shakes of a lamb's tail where that money's coming from if they get the outcome. And I don't think that necessarily flocking to the magic pills don't exist. And if we as advisors make sure we're setting our clients' expectations the right way, we're still going to get better outcomes for those clients regardless of the colour of the brand that sits on the loan paperwork.
All right. Lamb's tails and flocking. You love the sheep.
That's a great
One
one.
very last super quick question, and then we're going to wrap up. Yeah, Chris.
Hi everyone, great panel discussion. I'm not a broker, I'm a CFO and I work for SMEs. What really struck me today is your comment about it's a sugar fix for clients, and certainly the clients that I work with. What would you say is the broker's responsibility, or what can they do once the client gets that sugar hit to make sure they honour the follow-up?
Make sure that it's not the sugar hit that they actually need in the first place. So rather than, we always say to a broker or a broker who introduces or the client themselves, you come to us asking for a certain product sometimes, but that's not the product that you necessarily need. So my obligation is to do a full forensic overview of their financial position. That's where we will look at their bank statements and what's happening in their bank statements. We will look at all of their financials. We will not give them a low doc loan unless we've looked at their financials first. So we actually take the time to not say, okay, we've got this lead here, they want a low doc, no doc loan. Let's get them a product, nice and easy, get it settled. We'll actually get the financials and do the assessment to identify whether that in fact is the best product for the client.
Because 6 months down the track, they probably want to come back
And
if
when
they
I-
don't change their habits.
And also if I'm giving them say for example, the only solution is a short-term solution. What a lot of brokers are doing and what a lot of clients themselves are doing is they're saying they've got an exit strategy, but they're getting the loan for the sugar hit, whether it be a short-term facility or a private lending facility, without any real deep understanding of what comes next. So when I introduce a solution to those borrowers, it's about not providing you with the outcome for today, but I'm making sure that I've always got the end in mind, which is your exit strategy to be able to have that fulfilled. Because it's often the broker who's introduced the business. We always say to our brokers, these are your clients. We're not here to take your clients. So we're here to help you to move it. Then you take it back, or we're here, your trusted partner, whether we do it together, you do it separately. But you want to make sure that exit strategy can be actually achieved, that you haven't brought it right up to the max sort of capacity within that LVR. Sorry, go on. Yeah, so that you've looked at forensically, and not only that, but from a 360-degree perspective, that they will have an option moving forward. And sometimes it's a two-step option to get them back into, say, mainstream lending. It might need to be a consolidation, a restructure. We've done a lot of recoveries, reversals of recovery action, and done a lot of research, worked a lot with insolvency practitioners in the restructuring space. So that might need an immediate private, hyper-private solution to then get them into a specialist lending solution to then get them back into a prime solution. So it's often a three-step process with these.
We deal with a lot of CFOs, and we see a lot of CFOs that come really early into their relationship with the business, and there's pressure for them to add value fairly early in the piece to make sure they retain a job or have a longer retainer. And we find that finance tends to be a large chunk of that discussion. They want to get in there, they want to review that finance because they think that's, ironically, it's almost like a sugar hit for them. It's, hey, that's something quickly we can add some value and demonstrate our worth. The challenge is that so many people are so tied to your historic financials, and unless those CFOs are regularly looking at things like the debtor ledger, like the bank accounts and what have you, then they're not going to have that ongoing thing. Unfortunately, a lot of the sugar hits are based on ease, security and what have you. And I think the challenge for many of us in this room is it's great to get to a quick solution, but there are many lenders that are very predatory in terms of how they look at these clients in nature. And without the right guidance and regularly looking over those things, yeah, okay, those sugar hits become a little bit more important. If someone has their lovely quick tick and flick for their 50% LVR against an apartment in the toaster, and they go to the wrong lender, then magically that person behind that lender might think, geez, I'd like an apartment in the toaster, and they miss the payment, and then the next day it's sold up. So I suppose that the challenge is that there's sugar hits and sugar hits. Diagnosing the problem is absolutely key, but you'd like to think that when you're playing at that CFO role, you've obviously got that trusted advisory position, but like a broker, we're all part of that chain together. So I suppose the regular review, it's about the person in the chair.
All right, I'm going to give the very last word to Marty.
The only thing I'll add is I think it's just a matter of checking in constantly with clients and making sure that you're being proactive from that aspect. From a CFO perspective, it's more that reporting line to the lender group, and obviously you've got that intermediary from a broker perspective, but that clear communication, reporting, and those processes in a distress scenario, that the wheels fall off pretty quickly and you can see where those gaps are. So from that perspective, adding value to the business and making sure those processes internally are then relayed with reporting externally to your stakeholders like your lender group.
Right, Marty Chiotis, thank you so much. Daniela Mancuso, thank you. It's a privilege to have you. And Chris Slack, thank you very much. Thanks to our wonderful panel. I've been fascinated. I think it's been a great topic and you guys have really addressed it really well. I've got no doubt that a lot of the stuff we wanted to tick the boxes of what we covered, and we've covered it really well. So thank you to everyone for coming along.